Good morning. Welcome everyone to Admiral Markets. My name is Chris. We're going to take a look at the Forex market together and look what price is doing. But first of all, as you probably know, this PowerPoint explaining the strategy webinar of today. This is a bit different because we're looking at strategy creation itself. So that is different from our Tuesday and Thursday focus in the sense that Tuesday, Thursday is more technical analysis. Looking at maybe various tools and indicators, but today we want to focus really on specific strategies. Before we do that, though, there's a disclaimer explaining that the material here is for a global audience. First of all, that may mean that it's not suitable for everyone. To get the corresponding information on charting conditions and other details, take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity for more information on this part. Also, trading for exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and the content mentioned here and on the website and the terms and conditions of Admiral Markets. So we thank you for your attention. And with that said, with that important message behind us, we can now focus on today's intra-day and intra-week trading. We'll be using the strategy that we've been using already since we started. So if you're new in here by any chance, it would be pretty handy for me to know. You can write a short chat saying I'm new in the chat box, and that will provide me some idea, because otherwise I'll kind of assume that everyone is here already, has been here at least once or more. We're going to take a look at moving averages and pivot points primarily. The first strategy is using moving averages as a trending pullback or breakout opportunity. That depends on where price is in relationship also to the pivot points. For instance, if price is at a R or S2, then it wouldn't be so good to take breakouts anymore because the daily space is limited. Then a pullback might be good. But if price is still close to the daily pivot or close to within the Camarilla levels of L3H3, if you don't know what the Camarilla is, it's a type of pivot point indicator. Then then a breakout in the direction of where the moving averages are pointed. So if the moving averages are bullish, obviously we're looking for breakouts. The other strategy is looking for reversals, price action, candlestick patterns at major pivot points, preferably major pivot point confluences. We'll be explaining the strategy number one in more detail here. This is the three. We'll also have, if we have time, look at a Tenkan parabolic trend and break strategy. So probably this will be filling the entire webinar, but if we have time left, maybe we can even look at something else, but I'm not sure if we have more time than this. So the moving average strategy is looking for moving averages to be aligned. Usually I use the 13 and 34 EMA, but I have nothing, to be honest. This is, as we know, I've already said this yesterday and last week, is that basically anything that is between 10 and 30 in combination with anything that is around 30 to 50 EMAs is a good combination. So although technically speaking this is the combination that I mentioned here, you will see different variations on my chart because it really doesn't matter too much. For instance, in some cases I'll be using a 34 EMA close high and low, or 21 EMA close high and low, or sometimes I'll use this 13 and 34 EMA close. Right, so it basically just shows the direction of the trend. The angle will show the direction, and if they're aligned, it will be basically if it's an opportunity. If the 13 is above the 34, then the short term is moving faster than the long term. So in this case, on the screenshot on the right, we have an uptrend. Excuse me. But basically, the fib numbers are the ones I like the most. A lot of combinations, as I already showed you or told you, regarding these studies that have been done regarding moving averages are very good in their combinations. Filters could be news events, obviously, if price is showing divergence, for instance, or if it's close to a daily high or low, maybe. The trigger for a breakout is when price clears through the top or bottom nearby, or if it's a pullback, when price goes back to the moving averages. And the entry is a break of a fractal if you're looking for a breakout, for instance. But if you're looking for a pullback and a bounce, it could be a break, a close above the moving averages again. I know there's a lot of info. If you are new here, I can realize that. So be patient with me as we give some practical examples. I think that's more valuable. Trade management, I use tight or loose trail stops. In some cases, I even go from tight to loose to tight, depending on the trade development. At the very beginning, I like to be a bit tighter because if the trade doesn't go my way soon, the chances of a loss is actually increasing, so I want to cut my losses short. If it goes my way, I want to be a bit looser because if a pullback then occurs and I'm up a decent amount of pips, that's okay. I'm not that let's say quick in getting out because there's a decent chance of a follow-through. But as soon as you get into a big profit territory, then I want to tighten it up because if you get close to the end of, let's say, the expected daily range, I don't want to give too much profit back to the market. So I hope that makes sense why I do that. At the beginning, I want to cut the losses short, basically. Then I want to let the runners, the trade run a bit for a decent amount if possible. And then at the end, I want to cut it so I don't lose too much profit. So that's the ideal kind of model that I use. And how I do that, I'll explain in a real-life example. But one way is doing that is using tight moving averages at the beginning and time factor. If it takes 5 to 8 candles to move your way, that's already the max zone that I look for. If, for instance, price moves within those 5 to 8, at the beginning I might use a very tight moving average like 2 and 4 or 3 and 5 EMA close. But if it, typical. But if it moves my way, I might zoom out to 5 and 8. And if it goes at the end of the session, let's say, I might just go back to 1 and 3 or 2 and 4. All right? That would be the practical. If you want to use a more looser approach, the entire way, trail stop loss, 6 pips, each bottom or top of the 15-minute chart. Because we are looking at 15-minute charts for this breakout trade. It's an intraday trade. You can use it as a swing trade too. In that case, you want to look at hourlies. So that's a lot of info. But first, we need to take a look at this risk calendar. We got some medium news throughout the day. We have ADP in 5 hours. That's a big one. And we have Fed Chairman speaking in 8 hours. Tomorrow, by the way, we have NFP. One day earlier than usual because Friday is also a bank holiday in the U.S. So it's not an easy week if you're a swing trader or position, or specifically a swing trader. You want to wait for Thursday most likely if you're positioning yourself because that could have a big impact. Intraday trader, we can still trade today, but tomorrow is a day to avoid unless you're a news trader, just because of the expected quietness before the news event and expected volatility after it. So let's take a look. Raj is asking about how to use the pivot points for analysis. So I will address that as we go along. So I'll get to your question. Let me just first take a look at euro dollar, pound dollar, let's say. All right, 1 second, folks. Alrighty. So yesterday we were not able to break the weekly R2. All right, we had a big run up. The moving averages were nicely aligned. So if anyone took, as I said yesterday, these breakout trades because the moving averages were nicely pointed up, We had a good shelf here. A break above that was a nice breakout trade. Out of that range environment, finally, price moved up diligently, but yesterday it didn't get followed through. It did try, but no breakthrough. So obviously, if it didn't happen yesterday, you don't want to keep that overnight. So no loss there, but break even if anyone attempted to go long near these bottoms or even halfway. Couldn't break through eventually. This weekly R2 was too big of a resistance at the moment. However, looking at the 4-hourly, still bullish moving averages, getting a bit flatter, the angle. A pretty decent AO reading, which is a tad higher, so it does not look that like divergence because the AO is just a bit higher. So it does look like a momentum followed by now a correction. So if we put a fib just as a support to get an idea, price is maybe at the 23.6 fib. Could it move down to the 38.2? It could. If it does, it could be a good bouncing spot. Let me take the fib off though. Move down to the 15-minute chart, where we see that it's quite in a down move here, but recently a bounce. Therefore, if we look at the moving averages, price is in between them. We're looking for, from a moving average point of view, for price to be aligned, let's say below it, below the moving averages, for a breakout to the downside. We don't have that. If price were to get below the moving averages and then start to break maybe below this bottom, there could be a potential breakout down below here. But as we know from our higher analysis, the max we probably would expect is the 38.2 fib, which is equal to the L5. So if we then zoom in to the 50-minute chart, really the downside space is very limited. If anything, price could, when it breaks this bottom of 136.65-ish, 68, it only has 14 pips before it reaches L5. So because of that, it seems very limited in its outlook to the downside. And I'd probably rather wait for a price action candlestick bounce off of this support level than trading it to that level. The upside is different because we have momentum here. This is consolidation, so if it breaks to the upside, it's a different perspective of how much it could move to the upside. And a daily R2 would not be strange, for instance. So there is a bit more space to that upside. What we do want to see is price break above the daily pivot, preferably hook back to the moving averages and then maybe bounce. That would be the better trade to set up. All right. Now that's not going to happen soon, as we can see, because the moving averages are not yet aligned. So we can only talk about the future at the moment. We can only say if price does that, breaks a bit above, then hooks back, the moving averages will be bullish at that point, and then we can see a bounce. So you need a bit of vision here, how to how the moving averages, or a bit of experience how the moving averages behave when price makes certain movements to see how that can line up in the future. At the moment, it just isn't structured for a moving average breakout. That doesn't mean we cannot look at pivot points for maybe a reaction at pivot points. For instance, the second strategy is looking for reversals at pivot points. So in this regard, for instance, the confluence is here, monthly, weekly, but that is way, way lower. So the likelihood of price getting there is not so high. There's really nothing spectacular at the moment that I say here. There's a daily pivot, but certainly that could be a resistance zone, who knows, for downside. But because the 4-hour trend is up, I would not look for that trade. I know I said reversals, but what I mean with reversals is still reversals within logic. This is possible, but because the 4-hour is up and the 15 chart has such a momentum, this I think is not doesn't have the statistics in its favor, although it is possible. Pound dollar, or let me just take one thing. Let me just quickly check the higher time frames. Okay, nothing spectacular to that, in my opinion. But if price does break above yesterday's high, by the way, there could be some upside momentum this week and maybe next week up to the monthly R2, for instance. Pound dollar. The news event sent it higher yesterday, but as far as I remember, sorry for changing the chart so often, but let me take a look at this hourly first. As far as I remember, we were looking at this as a bull flag after momentum. So that did pan out, and we got followed through to the upside. For those looking at wave analysis that I post, you too were looking for upside continuation. At least if you went along with that analysis, you could potentially do that. The news event was the trigger, the catalyst, though, I think, for this first upside. After that, we just got like smaller like follow-throughs, but nothing very, very hefty after that. Some slight upside, nothing spectacular though. After that, we just went into an Asian consolidation and went flat as the pound dollar usually does, as we know. So what is there today? It still looks bullish to me. There's still no divergence between this top and this top. There's no divergence on the 4-hour as yet. There was no divergence between this top and this top. That's why when everyone was shorting in this blue-green zone, I was warning people that structure is still bullish because there's no divergence. There's a big momentum. There's a bull flag going on. We got a break. We got another bull flag, or deeper bull flag, in fact. Another break, another bull flag, another break. So yeah, this pattern is continuing, and reversals are still not happening. Are we close to a reversal? Not as yet, in my opinion, because we don't have divergence, first of all. I would like to see 4-hour divergence at the very minimum. Now, we don't have that. Why do we not have that? Because we only have maybe one red bar here, but we need at least 3 before we have a hump at the very minimum. So this is still an ongoing movement. And we don't know how far this AO can go as yet, unless it starts rounding like it did here and it did here. So it's still going on. So yeah, the catalyst for upside is still still present, and it just keeps breaking and breaking. So if we then look to the hourly, here upside, correction, upside, correction. If you look at the AO and the moving averages, upside, and still no divergence between these tops. So what seems likely to me is that once this gets to the 0 line, we're still going to break this top one more time. So in that regard, if we use one fib to have an idea what kind of correction we could expect, could be 23.6, 38.2 max before we get followed through. So ideas. The 38.2 fib was the same as the L4. There's also a weekly R2 and a daily S1. If price gets there, a candlestick rejection at that level, I think, would be neat at around 171. We have kind of like a supply-demand zone or a box here. Within a momentum box, momentum, that kind of zone is usually quite strong. So if price gets back to that, that's a bouncing spot as well. A stop loss, therefore, below that box would be a decent one, in my opinion. So if there's a lot of confluence, we got the box, we got the L4, we got the weekly R2, we got the daily S1. It's close to the expected ATR daily low. We got a clear low here. We have a 38.2 fib. A lot of confluence there. So if price does get there, maybe even a pending order, in my opinion, my humble opinion, at 171, 10-ish, with a stop loss at 170.90, wouldn't be too bad of a configuration. It's risky because it's a pending, or a confirmation like a 1-hour candlestick pattern at that level, to wait for a reaction to that level would be the other method. Now, what if price doesn't get that far, doesn't get that low? Let's take a look at the Camarilla. The Camarilla for those that are new in here, basically are showing different levels than pivot points. They're based on pivot points as far as I remember correctly, but they're show different levels. The H3 and L3 here are basically the daily range. That's when the daily chart, the intraday chart is within a range environment still. When price starts to break above it or below it, then you're getting more into a trending environment, especially if you then exceed H4 and L4. The target of which would be H5 and L5. So it's kind of a zone. Like this is more range zone. This is getting more trending. This is high trend, and then you get to the end. So it's a bit complementary to, it's sometimes equal to the pivot points, but it also complements basically adds another dynamic to the pivot point. So anyhow, what happens if we don't get down there to 171? Let's take a look at the 15, because in that case, excuse me, why, first of all, we have to look for breakouts to the upside. Now, as you notice, I'm not really looking for any downside. Even though price could fall down to that level, I wouldn't want to trade it because it's too risky in my opinion. It's too big of a trend. Now, why do I consider it an uptrend? Well, for those that are wondering still, maybe we can use, for instance, these moving averages, and you see it's bullish. 4 hour, you see it's bullish. So obviously bullish structure. The only way we could imagine a reversal if price really extends a lot from the moving averages and bumps into heavy resistance and preferably shows some kind of pin bar at that level. But if you look at the daily chart, you see strong daily candles. I don't see that rejection as yet, at least. Could be different today, who knows, after today, but based on what I know from the past, not as yet. So that bullish structure is there, no divergence either. So the only kind of reversal idea may be possible. We've got a weekly R3, but yeah, it's so bullish that probably would have to go all the way up to the daily R3, maybe monthly R1 today for myself to picture something out of a reversal. Maybe the ATR and daily R2. If there's some signs at 172 or 172.50, maybe at the end of the day. But those are quite early. So what rests is continuation at bouncing spots or breakout. So let's take a look at, we talked about the bounce, let's talk about the breakout now. How would a breakout look to the upside? Now, we have slightly bullish moving averages, but they're actually more flat than anything. Let me zoom out a bit, like this. We are bouncing between the L3 and H3. I've gone flat, as I said, throughout Asian session. So what I want to see is a bit of an angle on the moving averages, and then the next break above one of these fractals here. Now, as I said, we don't really have the angle, so I would like to see one more move up. It's basically like the euro-dollar. We do see that often at the beginning of the day, like what we're doing now, just because, especially on the euro-dollar and pound-dollar, because of the fact that euro and pound often move sideways throughout Asian session. What effect does that have? That means that the Asian session flattens the moving averages. It's not always so with the Aussie, for instance, or the dollar-yen or the yen pairs, right? Because they move a bit more on average throughout the Asian session. One of the reasons why I prefer to wait for kind of a sustainable direction on the euro-dollar or pound-dollar before trying to anticipate a trade on these two pairs, because of the fact that the moving averages are flat, the price tries to go away from them, doesn't necessarily mean that will be the direction of the day. Right? What can happen sometimes is you just see an up move, and then you get a rejection, and actually price does this for the next few hours, then bounces slowly but surely at the beginning of New York, and then starts to find some pace for maybe the last few hours or something like that. You know, a day like that could occur like this. So you don't want to go long when blue occurs necessarily, because it doesn't have to go up right then, right there. It could be a few hours later. But I wouldn't want to short it either, as I said, because of my bullish analysis. So that's why I want to be careful with the breakout. I want to see some confirmation of the moving averages having some angle like this. Then a breakout above this top is a potential entry, or let price break through it, then put a fib from swing high to swing low and take maybe the 38.2 or 50 fib for the continuation. That is something that I was thinking of yesterday. Let me show you an example of the euro yen so we have a practical idea how that would look like. Otherwise, let me just, before I do that, let me just look last time at this pound dollar. I don't think I have anything to add, in fact, besides this. So let's take a look at the euro yen to give a practical example. Yesterday, we were looking at this bounce here. We were saying, okay, price has been trending up. It broke, I remember very clearly, above the L3 here, but didn't reach the L4 as yet. Then started to make a retrace, moved back down below the moving averages, and I was saying that if it breaks above it, it could be an interesting follow-through and continuation. Remember? However, I skipped this candle break. Let me zoom into that area. Although that wouldn't have been a bad one, in fact, I was a bit more cautious because of the hourly. I wanted to see more confirmation on the hourly. But in theory, a close above these moving averages, this 21, could have been already an entry with the stop loss below here, like that. I wanted a bit more confirmation. So what I did was wait for the hourly to close. The hourly closed bullish, so that confirmed the bullish bias. But instead of taking this breakout above this top, I said I would rather wait for a fib down to the 38.2 or 50. And so the fib from here to here, on that breakout swing, indeed the 50 as a bounce went to the minus 272 target. Now I, in fact, was looking for 139.18/20, and it went to 13, unfortunately. So my TP was a bit off. I was looking for 139.20 and 18.20 and 139.40. Well, obviously, price didn't get there, so it wasn't a win, but it was either a break-even or a small profit, depending on how you managed it. But should not ever have been a loss, because when price starts to make a deeper retracement like that, you got to protect that trade and move it at least to below this bottom. And take at max, okay, maybe a max of a few pips loss. If you see a fractal here, definitely a move below that. In fact, the question is if even that, if it should have gone that far to up to here, because what I would have liked to see is, personally, was a bounce off this moving average and a direct follow through, not even a move back into the moving averages. So I used this bottom right in here. Right? There was no fractal, but it was just because this candle broke it by 0.1 pip. Otherwise, there was a 5-minute. There was clearly one. Oh, sorry, don't see it. But this was very close to being a bottom. Plus, there was a pin bar, a hammer off of that moving average. Another signal. That was the max I wanted to give space to that trade. Remember, we don't have any guarantee of a follow through. So even though we might, be tempted to give more space by letting it retrace deeper, as you can see, we don't always get buyers that step into the market again. So the pin bar, the hammer at the moving averages was for me reason enough. I gave it more than enough time and space to develop, and if it doesn't do it by then, well then, rather, give up on that one than hanging too long, basically. Okay. Sorry. That was yesterday. The pound yen, we said, was also a nice break potential, just like the euro yen. At that, when we were looking at the charts, it wasn't as well set as the euro yen because it didn't move above the moving averages, but eventually it did. In fact, that could have been fundy related. I don't remember. Let me take a look. Yeah, not really actually, because the close above the moving averages was, but actually half an hour later it started to really move up, I think, or not. No, it wasn't fundy related. Sorry. But the trade happened about an hour earlier. So the question is, do you want to take that or not? That is always a risk that you just have, every trader has to make in their own calculations. Difficult to say. It's really up to each trader. But in theory, if you ignore the event just for a second, then that would have been the entry there above the, could have been the entry with a candle close above that moving average bullish, or above these tops, or wait for a pullback after the break of the tops. But if you wait for the pullback, in this case, we didn't get a pullback. The EJ did, the pound yen didn't. So, that's sometimes the risk for waiting for a pullback. We just didn't get it. If you put a fib on this breakout candle, it only went to the 23.6 fib, not to the 38.2, not to the 50. And then went to the minus 618 target. So that's the risk that you sometimes would run with that. If you wait for a pullback, instead of taking the breakout here or here. If you use a loose stop loss, you would have just gotten taken out probably. Or maybe here actually. No, here actually, sorry. So anyhow, that was yesterday. Let's talk a bit more about now. So quick explanation about the pivot points, Raj, is that you can use the daily, monthly, weekly and look for price action signals at those levels to look for a bounce off of those levels. So let me see if I have an example, a good example that might happen soon. Here maybe, for instance, right? When the Kiwi yesterday moved down, I was looking for longs potentially at this weekly pivot point, for instance. I don't think we discussed that yesterday because it actually happened before our session. Sorry. But this pin bar, or this harami maybe is better said. It could be an example. That's a 50-minute chart, but okay. Let's see an hourly. We have a harami here, a couple of haramis, maybe a hammer at the weekly pivot point. That would be a way of using it. So you can use those pivot points to get an idea where price could stop and reverse and continue in its direction, in its trend maybe. Or just really make a reversal. Those main pivot points, the daily, weekly, monthly, are strong levels. Let's say the S1s, the R1s on the weekly and daily and monthly. If we have a couple of them, they give a bit more confluence. Let's say we have a daily R1 and a weekly R2. That close by. That's a confluence. Or if we have a daily R1 and a monthly, that's another confluence. So if price then stops there, it's an extra confluence. So there's a stronger level then because of that. So you can use when price is basically approaching them, either price is above it and going back to them, you could look for a bounce at those levels for upside. Or if price, for instance, is below it and it's moving up to a pivot, you can look for resistance rejection at it for more downside. Now, if I do think it makes sense to look at the overall trend because I think it's stronger to look for bounces back into the original, let's say the bigger trend direction, than maybe looking for rejection against the trend. I'm not sure if ATR can help in interpreting pivot points. What it could mean is, you could use ATR maybe to have an idea how far a currency could go to. And could it reach potentially a pivot point? Maybe. Not too sure. This Kiwi, for instance, is caught in between these pivot points. Had a bounce, as I said, a harami on the 15 off of this weekly, and is moving up. But at the moment, I wouldn't be too interested because it's still daily below the daily. We do have a slightly, of course, we have some uptrend here on the 15-minute moving averages. But the hourly is actually flat, which doesn't make it too interesting. The 15 could be a breakout above this top, but then we smack into the daily, so pivot point. So that doesn't make it too appealing. Let's take a look at the Aussie. See, that's the danger sometimes of taking shooting stars that occur maybe at spots that are not heavy confluence within an uptrend. You still get follow through a bit. Eventually, we did get a correction. Same story as the Kiwi. Actually, a bit different because the Aussie is flat below the daily pivot. So if it were to break below, yeah, this actually, from the 15-minute point of view, looking more bearish. But the hourly, yeah, it's also bearish. It has actually now at the moment it's bearish because it does have a downside angle. The 4-hour we know is bullish though. It's still a bit early though, because of the 4-hour chart, I believe. So we are close to ATR expected low. I'm not interested in the downside break, but not interested in the upside because we're not aligned as yet. Plus, we have the daily pivot still above us. So the Kiwi and New Zealand just don't show what I want to see, basically. Let's see if the dollar CAD could be a bit different. Alrighty. This is definitely a downtrend looking at the 50-minute chart. Continuing lower. So a breakout here is potential. Let's see, we have L3 still below us, which means there's plenty of space to the L5 still. $106 could be a strong level. It's a round number plus a daily S2 and a weekly S2. So, you know, the dollar CAD is not a big mover, but relatively speaking, there is potential here. Not a lot of pips, but it could be a follow through. So one way of looking at it is checking the 6 minutes from now is this 15-minute candle, looking if the candle is a strong close below this bottom, this purple bottom here, the smaller bottom on the 15-minute chart. If it has a strong close, it could be a small breakout trade to the downside, in fact, on this dollar CAD. So something to keep an eye on. If it turns into a hammer, then I'd rather wait because the moving average on the 15, although the trend is down on the bigger time frames, the moving average on the 15 is still flat. So therefore want to maybe a bit see more confirmation on that. You know, because there is not a ton of space here. As I said, 106 is a level to reckon with already. ATR expected high at low, sorry, at 106.06. So yeah, there's not really, you know, it's not like a sea of space, but worth taking a look at. Let's see if there's something better maybe going on. This is the dollar yen. Shooting star at the weekly pivot. I wasn't trading at that point, but if you were, that could be an interesting level to think of. Happened in the Asian session today. And that shooting star at the weekly pivot point is finding good downside. So within 5 to 8 candles. So this is going good. I personally would probably trail stop at each candle high. And depending on where you took it, you're up a few pips, which is probably about 1-to-1 at the moment because the stop loss was tight. If you use a stop loss above the high of the shooting star, it's really not big of a stop loss, obviously. Probably at max it could be 10 pips, maybe most likely a bit lower because I'm taking it spaciously. So that could easily be up, could be close to a 1-to-1. Anyhow, that was a potential trade that is like what we're looking for. What I'm looking for is strategy number 2, price action at candlesticks. This is a classical example of that. Happened 6 hours ago, though, but is a good example of representation of what I mean. Now I understand your question, Raj, more deeply. I thought the ATR at the bottom, you mean the ATR here, the indicator on the chart. How it can help with interpreting pivot points? Well, it's extra confluence for me. My experience with the ATR is not high as yet. I'm using it. I have it on the chart just to gain an experience with it in relationship to the pivot and the Camarilla. That's why. So it's not so big of a factor as yet. For me, it's just an extra confluence. This one is, unfortunately, it is proprietary. So I would need to check if it's possible. But you can send me an email and I'll check it for you. But anyhow, it's not my main one. So, but it sometimes, has an idea about the expected high or low. So yeah, the dollar yen here, getting back into an hourly bearish mode. So slowly but surely, 4 hours flat though. Not a big fan at the moment because of the 4-hour flatness. Price is approaching the daily pivot point as well. 15 is in the downtrend though. But overall, I don't like the bigger situation. That's why I would avoid this particular pair at the moment. So let's see if there's more stuff going on, more, something that could happen right here, right now, potentially. It has to be, if you're looking at a specific set of parameters for a strategy, then there's just always the chance that something doesn't line up at the moment, and everyone who has that has to look continuously at a certain intervals to see if something is lining up to trade. We can't do anything about it if you have specific strategies. Of course, if you trade discretionarily and you start looking at the charts and you just combine all your knowledge and experience and tools and indicators to make a decision right there, right then, that's something different. The disadvantage is that there's no method in the sense that you're just using everything to make a decision right then, right there. The advantage of having a clear-cut strategy is that you're waiting for stuff to happen before entering. The disadvantage is you need a bit of patience before those, it takes some time sometimes before it plays on. Euro yen correcting to the downside at the moment, downtrend of the 15 could already be worth maybe a breakout trade to the downside. This breakout to the downside could be okay. It too is early in the game though, but we might see an acceleration if we see break below L3 down to the weekly pivot point, for instance. This could be bearish. And the weekly pivot point could be a bouncing spot again. So one idea could be to break out to the downside, and the second idea could be a bounce off the weekly pivot point. These are 21 EMA bands, which means 21 EMA close, high and low. I have different templates that I use. So sometimes I switch them. Here you would see only the 21, and here you would see the 21 and the 13 and 34, like in the PowerPoint. But I switched them myself, so sometimes that's why you would see differences. But basically, according to that study, as I talked about, anything between 10 and 30 or with 30 and 50 is a good combination. So it really doesn't matter. The spirit of the idea is to look for basically a trend on this one. So on a pair, sorry. So obviously when you use the moving averages that are roughly the same level, it's going to be close. If you use the 21, 13, and 34, it does give a bit different perspective indeed, in the sense that here we can see they're not crossed. So from an hourly perspective, we wouldn't look for downside. On the 50-minute, they are. So if we only use the 50-minute chart, it would be a potential breakout below here. Because of the 1 hour not being aligned, I probably would be looking for one that's a bit more in sync with the hourly. Let's see if we have that, though. Maybe it's not there. That can happen sometimes. Pound out is not interesting because it's just sideways. Maybe the euro odd fell a decent amount. It's sideways too, but it had a good fall here. 4 hour is slightly bearish. This is an example of a turnaround at the weekly. However, I wouldn't have necessarily see any price action candlestick pattern that showing that potential at the weekly pivot point, unfortunately. So this is an example where we didn't get an hourly rejection. That can happen. But it is rejection. It is getting a rejection to weekly, despite that lack of a candle. The 15 is not yet bearish, though, so no alignment as yet at the moment. This is flat. A good alignment was yesterday, for instance, when you had the euro odd fall, hook back and break below it. That was a good trade there. That happened in the New York session. So how can you trade that? Just a quick, idea about trade management. An entry could have been when the candle closes below that band, for instance, or a break below this fractal. Obviously, one is earlier and maybe a bit more risky. The other one is a bit more confirmative. But what you do want to see is a 3 below the 8 EMA. And the candle closed below it at minimum. That could have been an entry. Stop loss above the top for a stop loss of about just a bit lower than 30 pips. Let's say 30 to make it easy, but probably 28, 29. Now you see that immediately the trade goes our way. First of all, one of the trade management things you want to think of is, does it go within our, my way within 5 to 8 candles? Candle 1, candle 2, candle 3, candle 4, well, yes. Candle 5, obviously, it's already up a lot. If it's up, about 1 to 1, I tend to move it to break even. So we got about 1 to 1 on this candle. So I move it to break even. And I loosen the moving averages to something like this. Not 2 or 4 or 3 or 5 or 1 or 3, but 2, 3, and 8. And the 3 stays below the 8 until we get a crossover somewhere here. That's where we can exit, roughly here. way at the bottom. So that was how you can get then about, if you took that entry there, about 73 pips, which is roughly 2.5.1 R2R. Or if you trail stop the 50-minute fractals by 6 pips, it would have been an exit here. Roughly the same, not much difference. It's important to see that because if you use any of these techniques, then you know how an example would look like. A good example, we'll find maybe good to find a bad example when it doesn't go our way. But yeah, we'll do that in a second. First, just want to finish this. Well, the usual pairs I look at, the moving averages are not aligned. So that's pretty simple. When looking at reversals at candlestick patterns, there doesn't seem to be a whole bunch that is waiting to occur. Actually, Euro New Zealand is breaking through the daily, not bouncing off of it. So Euro CAD maybe, if it gets up to the daily weekly pivot points here. That could be shorting area if it gets there. That would be on my watch list. Pound CAD a 15-minute shooting star at the daily, but that's already past us. Yeah, I don't see anything particularly interesting at the moment with these two strategies. No, not at the moment. Yeah, 3 and 8 is something that is looser. I like that because of the fact that you can let it run a bit more. If the fractal especially is not soon established. If there's a fractal, obviously there's not much problems. But what I notice is that if there's no fractals, traders get a bit nervous because you can't move your stop loss. If the trade is moving so much in our favor and our stop loss is still at the original spot, it actually can create nervousness because there's still the full risk on the table while we're up so much. One way of doing it, there's no real right way. One way you can take half of the profit here if you know, nothing wrong with taking some profit along the way. But here we get the fractal finally, but that took quite a while. So one way of doing that is using a looser stop moving averages to be a bit more conscious of the fact that it's going good, the trade. Moving into break even at 1-to-1 are all things that can help. Let's show the tighter ones, 4 and 2. Sometimes go a bit prematurely. Well, actually, 4 and 2 survived this one as well. Not only do crossover, but actually a candle close above the 2, and not only a candle close, but a candle close above the most, like the candle, the bearish candle that made the last low, basically. The close above that high. So in this case, there would be no change. This candle is the low, so only a close above that would change something. These candles here mean nothing. They're just inside candles. So I know there are a lot of concepts here that are used within the trade management exits, but it gives you a lot of weapons to tackle your own. Yeah, it's difficult to, and it's something that requires a bit more practice indeed. As I said at the beginning, I like to use this bell shape for moving averages and trail management, depending on the situation. I'm always talking about 8 or lower though. 8 or lower, not more. But yeah, that will take maybe some time, but depends on how you feel about it. I mean, how you see it, how your own experiences are, what strategy you use. The thing is that if you use a looser one, like a 3 and 8, from the very beginning, the trade can go against us, and we'll find out too late. But if it goes with us, we can do it because then we give more space to the trade. That's why I like to give tighter space at the beginning, more space halfway, and tighter at the end. Let's take a look at some losing example, or struggling example maybe. Oh, here's a good example. Price closes below it, below the moving averages. Price, let me check how this situation looks like on the other template as well. Oh. Now I forgot which part it was. Was it here? No, it wasn't here. I don't remember. Maybe here, this zone. I don't know. Sorry, let me go back to that other template. '26th of June. 1 second, folks. 21:45. Good. So you can see that both templates, either using the 21 EMA band, high, low, and close, or the 13 and 34 EMA. Sorry, this is 21 and 34 because it's a 50-minute chart. Excuse me. So 15, I'm using 21 and 34. 1 hour, 13:34. If I use two moving averages, if I use a band, I use 34, as you know, or 21. These are all EMAs. This is closed though, only closes, and this is high, low, close. Anyhow, it's either the 21 or the 34, not both though. That would make it a bit too crowded. So both had a breakout here potentially. A hook back and a break below the moving average again. However, we see a struggle. We see 1, 2, 3, 4, 5, 6, 8 candles not go our way. A bit, but not much. So then we have two things that keep us, careful. If we use let's say the medium short moving average, like a 2 and a 4 typical, simple typical, then we can see that we get a crossover roughly about here. The candle to keep an eye on that made the low is this one. That candle has the lowest low. So that high of the candle is something that we don't want to close above, because if it closes above that, the bears are not in control anymore. That happens here, whereas we had the crossover already here. Obviously, if we took a short here, also we realized that after entry, it has already been 12 candles that have not pushed our way, which is far exceeding our 5 to 8. That trade is not going our way. I'm exiting. I would probably even exit earlier, but that would be the max exit. Trade is just not developing our way. But if it does move our way, let's take a look at this breakout. 1, 2, 3, 4, 5, 6, 7. It is going our way, right? Then let's see. We can use the tighter ones maybe at the beginning to have an idea. Now this was a close call because this is the high to keep an eye on, and it was right equal to the close, but the close was low enough to still stay in it. If it would have been one more bullish candle, the 2 and the 4 EMA would have suggested an exit though, so that stayed in. So once we got the follow through, then we could move it to a higher one because we maybe want to avoid getting taken out here, or actually the 2 and the 4 would not have gotten taken out there. Why? Because the candle with the lowest low, just this one, right here, the left right red button, the red line there. You see that one? That candle has the lowest low. That high we don't want to see it close above it. So it never happened actually. All inside candles, and we got followed through. So actually a 2 and 4 would have survived, but 3 and 5 makes sense to maybe survive sometimes some pullbacks here before you get one more move down. Then you want to tighten it up again because when you make the next move down, the likelihood of a bigger retrace increases, right? So you get follow through, retracement, follow through, bigger retracement. Then again, a continuation. We try it, didn't go, flat, break even, and we might try again somewhere here. Okay, but let's focus for the moment here still. So the exit would have been this candle, for instance, because that's where we got right here. That would be the exit because the candle close was well above the bearish candle. The 2 crossed the 4. The close was above the 2. That was a change in dynamic. That was a change of ownership. The bulls got control back. So the entry could have been at this this candle here, for instance, or this one. The difference between those two lines is about 34 pips. The stop loss would be above the top and looking around 15. Now obviously this is a piercing candlestick pattern of 15. It's a very strong candlestick pattern considering the fact that we didn't have anything of the sort in this entire downside. Someone who chose to close there, I wouldn't blame that person, to be honest. You know, so this is nothing wrong with that either. It's a very strong piercing candle. So, plus we already had, if you look at the AO, we had a hump, a dip, and another hump. Usually after that, the AO goes back to the 0 line. So, plus the candlestick pattern, it could have been a bit better exit. But so I know maybe for some of you this is a bit maybe on the boring side because the entries are normally getting most attention, potential entries, potential setups, potential analysis. But the exits, in fact, you know, many traders say that actually exits can be more important than entries, although more time is spent on entries. So discussing various exits and how to exit and what could be good exits, what way could you limit risk, etc. Is I think a good thing, a good exercise. So for those that have patience with that and are looking at this examples, I think it's well worth your time because I don't think much attention is given to exits, relatively speaking. But if I think you ask 100 traders, 90 of them are going to say exits are more important. Let's see. After a big drop, you say tighten the MA. Yeah, if you get into, well, we don't see any of the pivot points on this chart because this was in the past, so we don't have that information, unfortunately. But indeed, if you get a follow through, you see a small drop here. Let's say a 5-minute retracement. This is a bit of about a 5-minute retracement, kind of. That's one way we want to tighten it. If you get into anything above 2 to 1 R2R, for instance, you might want to think about that. If you get 5-minute retracement and follow through, you might want to think about that. If you get close into above the S2, below the R2, sorry, above, other way around, above the R2, below the S2, or close to major pivot points like weekly, monthly, those could all be reasons why you want to tighten them indeed. Let's see. Let me put the template back on so we get rid of all these lines. Let's see. It's not a perfect way to do it because we're missing information of that day. So we're only looking at moving averages. So it's not the full picture. Let me see. I'll try to find a situation where we're struggling again. So this is a good example of a follow-through. You can use 2 and 4 EMA on the hourly too. If you take a reversal with the candlestick pattern at the pivot point, you can put a 2 and 4 EMA. Use the same 5 to 8 candlestick pattern rule. Oh, sorry, number of candles. Basically, you can use any of these concepts on the hourly, 4-hour, daily. You could use them for all of them. So definitely, you could use that. One thing, by the way, you can look for is a strong close, right? We talked about that in the past, but one time to reemphasize that is this is a candle close that not is only closing above the moving averages, but it's a candle close near the high. That's a good sign. That's another reason why a long there could be good. To close as well above these fractals. So that's a good example. 1, 2, 3, 4, 5, 6 candle goes, 7 candle, good. It's going our way. Now, that's what I mean with loosening the moving averages, because if you exit here, it's a shame. You're, in a way, cutting our winners short, because the 2 cross the 4. Now, let me see if we actually okay, it's not, well, actually, it's an incorrect example because we never closed below this candle. That was the last bullish candle. That was the last, the bullish candle with the highest high, so we need to take a look at the low. We never got to close below that low, so we actually avoided an exit there. But let's say, theoretically, the close would have been 1 pip lower. It would have been a premature close, probably, and if we use a bit longer moving averages, we would have survived the smaller pullback for follow-through, because it was going our way. It was just a pullback for more, and we want to avoid getting taken out at basically the bottom of the pullback when it then continues. That's the whole idea to avoid, because now it's going our way. We want to be tight here, but when it goes our way, we want to give a bit more space so we get the follow-through. Right? So anyhow, let's take a look at a bit worse example here. We got a good strong close above the moving averages. We have a dip, follow through, okay? So that we don't know at that point. It could be follow through, right? We don't know that. We have strong AO. We have AO back to zero line. We have a strong close above the moving average. Moving averages are bullish again. Everything in play for potential further upside. What happens then? We see 1, 2, 3, 4, 5, 6, 7, 8, 9. Too many candles. After the 8, it's too many already. So how do we look at it? If we look at the 2 and the 4, we see, for instance, the 2 and the 4, we see, this is not 4, sorry. We see a crossover here. That close of that candle, this candle, is below the candle with the highest high, that's an immediate exit there at the very, very, very latest, which means it's looking at a 4 pip loss, 4.5 plus spread, compared to about a 28 risk. Now what is, let's say, 6 pips versus 28? Not much, right? It is probably 0.22, I think, units of risk lost. So that's keeping losses short. Now, that's the very max. To be honest, if I see wicks like this, from a candlestick point of view, after pin bars like that at the moving averages, I like to really see 5 to 8 candles. So if it's 1, 2, 3, 4, 5, 6, 7, 8, okay, fine. This pin bar, this wick would probably be enough for me to say forget it. I'm moving it to below this candle, probably low, but that wouldn't save much pips anyhow. Or maybe even taking it out right there. That would have been a break-even trade right at that candles, because that's already the 10th candle. So this didn't signal follow through because it didn't close above these highs. Didn't close above these highs. Had a very weak close with a big wick. Second wick already, and that was the 10th candle. So, boom, over. No follow through at that point. This one had a wick when breaking out, and there's no angle anymore, so nothing. Let's see. Here's a close. It's not too bad. We see 1, 2, 3, 4, 5, 6, 7, 8 candles. Takes long. Here another wick, so that would be break even. Unless you put the top loss below, very tight below this, I'd rather put it a bit with the, if the fractal's in the moving averages, I'd rather use a bit more, one that's a bit below it, either here for instance. This one was below the moving averages, so that's the difference. Be aware of that with the stop loss. Okay. All right, so we don't know if these are necessarily how the whole pivot points are reacting. I'm just looking at the moving averages as is. Okay. Let's see. Here we have a potential entry, and here too. 1, 2, 3, 4, 5, 6, 7, 8. Too many candles. 1, 2, 3, 4, 5, 6, 7, 8. Also 8 on the verge, but then the 9th goes our way. So that probably would have been a cliffhanger, but would have been survivable. So etc. So anyhow, that's the trade management stuff. I hope you've found some of these concepts maybe useful for yourself, maybe. Let's see if anything changed. Good. Great to hear that, Kayla. So you can use maybe a combination of these things or additions to your own trading. We can do that. We can make a 1-hour webinar on this, definitely. Let me write that down because otherwise I'll forget. Let's see, I'll put it in my notes somewhere. But by all means, feel free to remind me. I wouldn't feel offended if you remind me next week, just in case I don't see that message. Let's see. Good. Wrote it down. I have a reminder there. So let's see, anything new? I got a Harami on the pound dollar, but I'm not selling that because it's bullish moving averages. So I'm waiting, as I said, for some follow through. If we get that to the upside, it might be a struggle today. Kiwi, maybe a bit of a shooting star at the daily pivot, but that is something maybe to look at, but the hourly is a pretty strong close. So it actually puts the moving averages back in the upside. I therefore would not consider that something interesting. Dollar CAD had a close below it, below this pink line, so that could be a breakout, but be careful of, I think the expectations are quite limited, the downside potential, but we got a bit of retracement, so that could have given some discount, a few pips discount, if you had the patience there. Otherwise, yeah. Euro yen could be a 50-minute fall, but it's not hourly aligned. Hourly, nothing is aligned at the moment. That's the thing. Nothing. But you know, not only hourly, it could be used for the 4-hour chart as well. Look, for instance, at this 21 EMA in relationship to the 1-hour chart. Got an upside, a dip below, back up. We got a close above. Let me show you this on the hourly, but first I want to still use these moving averages. 1 second. The same principle could be used, it just takes longer. Up, dip above again, and we get a close above the moving averages. The moving averages are flat, so that could be a bit concerning. A breakout, therefore, above the fractal might be a bit better than actually the candle close. Something to think about, but it depends on the higher situation. If the daily was up, that could have been worth it because you have the power of the daily pushing it. Now, the pound dollar daily is up, so the candle close above it could be enough maybe, or the break of this fractal, or even the candle close above the fractal. In any case, that could be a swing trade. 1 second. I don't have those moving averages. So if we use the 3 and the 8, the exit would have been here, unfortunately. But still not bad. Re-entry would be possible here at this candle. That would not have really survived too long, though. Exit there again. Unless you do something discretionary and say this is a bull flag and I'd rather wait, but I mean, if you really take it strictly. But all setups, by the way, 1, 2, 3, 4, 5, 6, 7, within those candles, within the 5 to 8, right? This one, 2, this entry, 1, 2, 3 went our way. 1, 2, 3, 4, all within that way. So time factor itself is just pretty handy. This one, let's take a look. Maybe it took a bit longer. 1, 2, 3, 4, 5, 6, 7, 8 definitely took a bit longer. We're going already above the 8. Let's take a look. The 8th is a harami. So an easy rule in this case would be to use this bottom to move the stop loss to, because we're already in time pressure. Let's see. Yeah, this is a question mark. I think if I could move my stop loss to a bottom like this and therefore reduce the risk, from about 60 pips, no, sorry, to from about 75 to 20, I probably would have patience in this still. Just, although it's candle 9 and 10, because the risk is less, I would have that patience extra. If the risk wouldn't be reduced, then I wouldn't have the patience. You see the difference there? So I wasn't trading this 4-hour chart, by the way, but this is therefore, of course, difficult to say. But I'm just giving you at least the reasoning so that you have an idea of why. But it's just as typical on the 4-hour indeed. The hour, then we get the follow through. Yeah, the 3 is still above the 8. The last bullish candle was this one, so the low of that is important. If we get a close below that level, I would probably exit for whatever profit there is. Actually, the stop loss could already be moved again to below this bottom, in my opinion. Locking in already something about 60 pips, 65. and a close below this 170-130 of a 4-hour chart would then justify an exit. We had a break, dip, and follow through, so we could go back to the short-term moving average, in my opinion, or leave the long ones. It's a bit not. This one is maybe a bit grayish, but there's not always a necessarily as clear cut in every situation, but you can make sometimes, of course, the judgment call. In this case, I think I would actually leave the 3 and the 8 for the moment. If I look at the hourly, I don't see divergence, so that could be one reason to still have a bit more patience with the 4-hour, for instance. Well, folks, thanks for being here. I hope you'll join us tonight with Nennet. Let's take a look what he is showing. Why do traders lose money? That's tonight. Tomorrow, we'll take a look at Camarilla in the morning, same time, and then Thursday evening, stages of trading and how we personally developed in that. So 3 more webinars this week. Hope to see you then. Oh, let's see. I got one more question. Sorry. Hourly. It's a difficult question because it depends on some factors. Like if it's a reversal trade, I would probably be more on top of things. Well, I think optimally starting out with 2 and 4 is never a bad thing. And then if it moves your way, moving to 3 to 8. I know it's maybe it's maybe difficult, but that's, I guess, optimally. But if you want to stick to one of the two, let's say one specific parameters, maybe you can find a balance like 2 and 5 or 3 and 5, or yeah, maybe like more in the middle there. Let's take a look at this hourly. Like the dollar yen, I shorted the dollar yen, got out of it for only took a loss, for instance, yesterday, based on this tweezer top at the weekly pivot or close to it. Bearish candle after that, so I shorted it. 1, 2, 3, 4, 5th candle was a harami. I exited on the harami for really like break even, maybe out of very little loss, right? The minimum I give is 5, but if I see a harami on the 5th and I saw a very bullish candle on the 3rd, that was already enough for me to exit there right then. I didn't even wait to the 8th. That's why I say 5 to 8, depending on the situation. Also, the moving averages were bullish, and we're seeing wicks at the moving averages, so that's another thing I didn't like this short. And we did get the push up, and then we did get that rejection, but later. The shooting star at the weekly happened later. So anyhow, back to your moving average question. What do I suggest? Let's take a look whether this is 2 and 5. So let's take a look how does 2 and 5 reacted. So the 2 stayed below the 5 until we got this 6th candle. Doesn't look too bad. That exit was 1 hour later than me. Only 1 pip worse, so that does not seem too bad. 2 and 5. Let's make it 2 and 4. Here the crossover could have already happened at the harami, as we can see maybe. Ironically enough, it's only showing me the 2 EMA. Probably because the 4 is so close to it that I cannot even get it. So it's very close. So yeah, they're probably equal to each other, roughly speaking. So slight difference. But usually, these do pretty good for momentum. If it's really giving a momentum, let's take a look. Like this. This is a momentum down on the dollar yen, right? So we see the 2, we see an inverted hammer, we see the 2 below the 4, and a close below the band here, right? So let's say we short here on the hourly. So we see everything follow through. The 2 below the 4, the 2 below the 4. When does the 2 go above the 4? Probably on this bullish one, but if not, then on this one. So that could have been an exit, or if you really are patient, you can still keep the stop loss above this, the biggest hourly, the biggest bearish candle. This was the bearish candle with the lowest low. The highest low of it is the game changer. Everything in between are inside candles. All of this is inside chop. So within that one bearish candle, therefore, if you really had patience, you could have even lived through it, put the stop loss there, live through it, and see if it makes it, which really didn't give much value. If you don't want to live through that big of a sideways zone, which I cannot fully understand, then you would want to exit somewhere here probably, based on that 2 to 4 change there. So if it's really a lot of momentum, then you would see a pretty good follow through. Now, if it's choppy, of course, you're going to see that chop a lot, right? But if it's a good momentum like that, you see the crossover happens where? On this candle, this one, and the close above the 2. On this upside, the opposite happens here or here, depending on how aggressive you want to be. 2 below the 4, close below the 2, and the close also below the dominant bullish candle, which, yeah, this is a difficult one because this is actually a spinning top. I would take that low, not this low, to be honest. That's a bit of an exception. I would not take this bullish candle here because we have a spinning top with a higher high and higher low still. So I would take that one. So yeah, that would be the exit then there. So that's how you can use 2 and 4 on the hourly then. All right, folks, thanks so much, and have a great day. Cheers.